Hey everybody, Lawrence from financialthing.com here. Thursday evening live stream. Hope you're having a great week. Very much appreciate you joining as I do every week. Let me take these headphones out. Not sure why I have those things in, but yeah, coming up towards the magical Christmas period. This will be my second to last stream probably of December. So we'll be here next Thursday and likely, well, definitely not here the Thursday after, which is, gosh, let me look on my calendar. So I'll be here on the 15th. We'll not be here on the 22nd. We'll not be here on the 29th, but I might do an impromptu New Year's Day stream. Who knows? We'll see. Maybe Friday the 30th of December. But I'll always send you an email, so if you're signed up for the email list, you're going to get a notification. If you're not, go sign up on financialthing.com so you can be kept in the know. We have a lot to talk about tonight. We're going to be talking peer-to-peer. A couple of peer-to-peer lending companies announcing that they had record months for loan completions. We had a very interesting November update from PropLend. Some things in there that I thought were really, really interesting that PropLend sent out. So we're going to go through that. A couple of other news stories I thought were pretty cool. We're going to talk about Property Partner, take a look at the Trading 212 portfolio, and some other interesting things. So it's been kind of a busy week for happenings within the peer-to-peer lending and investing world. Let's get right into it. We don't want to delay. See who's here. If you want to have a quick shout out in the chat, let me know where you're calling from. Calling. Yeah, you can call in. Oh, my Patreon thing looks really small. Yeah, let me know where you're viewing in from today, and it's always nice for me to see where in the world you are. And hit that thumbs up if you can. It's very, very helpful. Takes a second. Colin is here in the Peak District. Peter in Leatherhead, Allen Toombs, and freezing Basingstoke. Sorry it's so cold. I'm expecting very cold temperatures the day that I set foot into the UK. I'm expecting minus 20, probably some snow, a few blizzards, definitely some rainstorms. So, you know, this is nothing new. Hi from John Morgan, Sub-Zero Swindon, Paul in Kenilworth, of course. Alan in icy Worcestershire, which is going to produce icy Worcestershire sauce. And Paul New in a very cold Stockport, and Patty in I don't know if it's cold there in France. I would imagine it is. But welcome again, wherever you're watching from in the UK or in the world. And if you're watching in the future, welcome to you. Come hop on live on a Thursday, 7:30 p.m. UK time. Hello, Aki Chap, of course. Yeah, let's get right into the news and see what's interesting out there. Let's pop this up. Here we go. Capital Rise declares October a record month for loan completions. They have announced that various credit records in October were surpassed, including processing deals that equated to more than £50 million in a single week. So Capital Rise doing those London deals, which, London's been through its challenges when it comes to property through the pandemic, but Capital Rise found a way to capitalize. That rhymes, Capital Rise, capitalize. And they were doing some pretty big numbers there. The business has also achieved a record-breaking week for completions in October, with 3 completions in a week totaling £21.5 million of loan origination. So if you're looking for a place to put money, seems like Capital Rise is going to have some deals for you to invest in. And they have originated more than £200 million of loans and funding developments across London throughout the inception of Capital Rise. And these home counties, or these homes, have a value of over £640 million. So Capital Rise doing some big things. Congrats to them. Uma Raja. Investment Fund predicts build-to-let trends for 2023. Of course, we know about buy-to-let. Build-to-let is where developers take either an existing building, rebuild, and then keep it in their property portfolios for rentals, or just take a piece of raw land and build rental units up to keep in the portfolio. Savills has revealed that more than £5 billion has been invested into the build-to-let private sector across 2021, citing rental income growth as the main driver. What this means to you is there probably going to be a lot more peer-to-peer lending deals that come through that are funding build-to-let trends for the years 2023. This is why I talk about it, because it affects peer-to-peer lending. Investment fund predicted that rental yields will continue to rise in the near future. Theoretically, in a recession, mortgages become less attainable or too expensive in the short term for some, forcing up rental demand. Zoopla's annual market rent report found that rental yields increased by 12.3% in 2022. I know they certainly have around where I am here in the States. Rental properties have just gone crazy. Mortgages have become more expensive. Rental demand is a lot higher. So this is going to bode well for the peer-to-peer lending sector in 2023, and these companies that are going to fund some of this type of development lending. We're starting off with good news today. Usually I have some not so good news, but Shojin has reported 133% rise in turnover according to their year-ending accounts that ended the 30th of June 2022. They've reported, zoom in a little bit more, 133% increase of turnover to 2.1 million, which is up from just under 900,000. The peer-to-peer lending's latest accounts show the firm has seen profits rise by 85% from 773,000 in June 2021 to 1.4 million at the close of the financial year on June the 30th of 2022. So their profit is up, revenues are up. The thing, I was trying to find these accounts on Companies House, which was showing those numbers, and I don't know if I'm missing something, but the only accounts that I stumbled across was this Shojin Financial Services Limited, and that shows that they actually took a loss for the financial year. I don't know if this is some kind of a operating company or a sub company, so I'm not really sure where these numbers are coming from. I did see a few different Shojin companies here on Companies House, but this is something, it becomes quite difficult sometimes finding these companies and finding the correct company in the accounts, because some of these are just shell companies that are opened up to house development projects or loans. So it's going to be tricky trying to find exactly the right numbers, but I have to take these numbers that peer-to-peer finance news is reporting to be correct, which if they are, which I presume they are, Shojin has done a really good job for the year ending 30th of June 2022. We'd like to see reports like this coming out because it means the company is doing well, and we always want to see peer-to-peer lending companies being in profitable, in the black. We see losses. We've been used to seeing losses in peer-to-peer lending for these companies' operation costs being high, profits being low. We've seen that for a long time, so it's nice to see now that companies are starting to put up good numbers, which means they're surviving and thriving, which is exactly what we want to see. Let's continue. We had the winners announced at the Peer-to-Peer Finance Awards. Again, this is peer-to-peer finance news. Some of this I wasn't really too bothered about, but if we go down and look at the things that we would probably be interested in. Consumer Lender of the Year right here, Lendwise. Pretty cool. It's a company we cover here. Business Lender of the Year, Folk to Folk. Hoping to have them on January. We got them penciled in to come onto the stream live. Hopefully some other guests in January too that I've reached out for, just trying to get the date set when they're going to be able to come and have a chit chat. Property Development Lender of the Year, we have Crowd Property, highly commended Relendex. Winning Bridging Lender of the Year winner, Kuflink. Boys over at Kuflink getting commended for their business and what they've been able to do in peer-to-peer lending. And Buy-to-Let Lender of the Year, Assets Exchange, again, companies we cover here. Winner of Ethical Lender of the Year, Assets Exchange, Rising Star, Plend, or Plend. I don't know who Lande Finance is. Highly commended Quadus. I've reached out to Quadus to get them on the stream too. Innovative Lender of the Year, Axia Funder, and highly commended Shojin. And the CEO of the Year, Narinder Kaur, of course, who we've had on the stream several times, CEO of Kuflink, so congrats to him. Peer-to-peer lending platform of the year, Folk to Folk. So they took the big winning trophy home of peer-to-peer lending platform of the year, and highly recommended Assets Capital Investors Choice Award, Kuflink. I think this Investors Choice Award is probably the one that I think is most important, and the reason I say that is how they decide who gets these accolades is determined by a panel of respected industry experts, former rate setter boss Ridian Lewis, innovative finance chief Janine Hurt, and Neil Faulkner, chief executive head research of Fourth Way. So my question becomes, is the former rate setter boss Ridian Lewis really current on these different peer-to-peer lending companies and what they're doing? How is he deciding where his vote goes? Does he know really what Kuflink is up to? Does he know what Crowd Property is up to? My guess is he probably doesn't have much of a hand in peer-to-peer lending anymore, and I'm just speculating. But, RateSetter really doesn't do peer-to-peer retail lending anymore. Now, Neil Faulkner over at Fourth Way, I think, is a fine candidate to be a judge. He would be somebody that does a heck of a lot of research and digging into these peer-to-peer lending. Now, innovative finance chief executive Janine Hurt, I don't know what her deal is, but I wonder if this is really the best choice of having a panel. I would say, having votes from people that are actually investing in these companies would be better, even though that could be biased. It's a tricky one. Because how do you get an actual unbiased view of which exactly peer-to-peer company is the best? So I find that interesting that, they've, the panel is just 3 people, with one of them probably out of touch with the peer-to-peer lending world. One of them definitely in touch, who I think is a great choice. The other one, not sure about. So maybe they're going to tweak that next year. That would be cool if they had a bigger panel with maybe some different people. Peer-to-peer finance news, I'm open. If you'd like to get my input, I'll be on your panel. I'm not saying I'm necessarily the right person. But we saw here on LinkedIn, Kuflink, they said, what a night. We are so proud to have won not 1, not 2, but 3 awards at the Peer-to-Peer Finance Awards last night. Bridging Lender of the Year, CEO of the Year. What a great achievement. Investors' Choice, obviously winning that. So really good congratulations to them. And then Folk to Folk also posting their trophy with a nice zombie hand at the bottom here, saying they won Peer-to-Peer Platform of the Year. So really great job to those companies, and congrats. And then we have the dark horse here. Of course, we have to look at the bad news too. Funding secure realizations reached 43.8 million. This is just a story about the administration and how they've recovered nearly 43.8 million. Does that make the investors feel better? I'm not so sure. There's still 51 loans in default as of the 23rd of October, with a total value of just over 25.7 million. So those need to be taken care of. And of course, we've got the high administration fees that have totaled 72,531 over the 6-month period, bringing the total to a whopping 808,353 pounds. So 808 grand of investors' money has gone into the pockets of the administrators, who have a very tough job sorting out this administration. Not bashing them necessarily. That's a difficult job. I would not want it. It's got to be a complete nightmare trying to deal with these borrowers who are in default, trying to deal with the accounting. It's probably not very clean. Who knows what the record keeping was like. It just sounds like a complete headache. So they probably do deserve to get a good wage for their for the services that are provided. How much that wage should be, not so sure about that, but that's what's going on over there. We had a November update from PropLend, who also has a record-breaking month. So we've had really good news from Shojin, Capital Rise, and now PropLend. I like this newsletter. There's something very interesting in here that I was surprised they called out, but I think Brian Bartby, CEO, has never been one to not throw punches. He's quite vocal, which I can appreciate. That's refreshing. But this letter says, with a news cycle full of depressing news, we thought we would buck the trend and kick off this newsletter with a bit of good news. November has been our best month ever funding loans, both by volume of loans and by the number of loans. Big thank you to all the lenders. And we have funded our 200th loan. So congratulations to PropLend. I personally don't invest through them just because their limits are high on the loans, but very impressed with what Brian is doing over there. He's got a good track record. Again, not financial advice. I don't invest in through them, but I've heard very good things from people that do invest, and 200 loans funded is very good. Then we have some very interesting rhetoric that was written in this that says, we know that many of our lenders hold accounts across several peer-to-peer platforms. We were disheartened to learn that one has taken the decision to restrict lender withdrawals, citing the requirement to maintain sufficient funds on the platform in order to ensure that committed property developments remain fully funded. Of course, we know that PropLend is referring to Assets Capital, how they have restricted withdrawals on their access accounts because they need the money in there to fund future tranches. So PropLend kind of throwing some punches over Assets Capital, and they go on to say, we have spoken out publicly on this previously, and that we never felt property development funding with the requirement for multiple phase monthly drawdowns was a suitable product for the traditional peer-to-peer funding model. On paper, funding monthly drawdowns as and when they are required is very efficient. The borrower only pays interest on money as they draw these monies down, but if one drawdown request fails to be funded by lenders, the development grinds to a halt. This is possibly the worst possible scenario for any property development. Historically, banks would agree and commit to providing the total development funding requirement. The borrower would then pay one interest rate on the funds they had drawn down and a separate non-utilization fee on the funds which they hadn't yet drawn down. This basically ensures that the borrower has enough money to continue funding their development. So PropLend goes on to say they are focused on commercial property loans. We are lending against day one as is value, and the loan goes out in one lump sum with no further drawdowns. It enables us to overlay our loan-to-value risk model, meaning lenders with different parameters and return requirements can all participate in the same loan. Over 75% of our loans have been secured by properties producing tenant income. Lenders are not exposed to development risk, which encompasses planning, permission issues, groundwork issues, all kinds of different things that can cause problems with this type of lending that Assets Capital is involved in. We cannot claim that PropLend, our niche in commercial property lending or business model, is perfect, but we make a clear statement by not going down the property development funding route. Whilst in most cases it offers lenders higher returns, but it exposes them to a very different risk profile. Now, I thought this is very interesting because it does bring up some issues with tranche-based and monthly drawdown things that we've seen happen in the past with certain peer-to-peer lending companies, that if it's a multiple tranche loan, so tranche 1 gets funded, tranche 2 gets funded, and there's maybe 5 or 6 or God knows how many different tranches, and the tranches don't get funded later on. Some of these peer-to-peer lending companies don't have a backup to be able to fund those tranches at later down the road, which is what really PropLend is talking about here. Now, if a peer-to-peer lending company does have a facility in their back pocket to be able to fund tranches that don't get funded by you and I, hence retail peer-to-peer lenders, then I have no issue with this type of business model. Where the risk therein lies and becomes difficult is, as PropLend is saying, Brian over there, that you run risk as a lender that if those later tranches don't get funded and there is no backup model to fund those later tranches, that loan could certainly run into big problems. And then this eventually obviously ends in us highlighting exactly what has happened with Assets Capital's Access product, where withdrawals have been halted because people are exiting. I don't know to what extent, how bad this exiting is. But when people start to exit and assets have to put the brakes on that and say, you can't take your money out because we need your money to fund this development and these monthly drawdowns, then we as lenders are placed in a very risky position. So it does make one rethink, is that business model that Assets Capital is using, how risky is it? And especially for the interest rates the one is getting paid. You're getting paid 4 or 5%, taking a lot of risk to receive a small amount of interest. I think Assets Capital is really going to have to look at their business model and change how they do that, because after this, pause on withdrawal, I think they're going to see a lot of people, when that pause is released or ended, they're going to see people start to exit because nobody wants to be told, even though we have to say the exit is never guaranteed from any investment within peer-to-peer lending. You have to remember that, but we've been used to certain conditions and having some level of flexibility to be able to withdraw. So I think PropLend really highlights some interesting points. I was surprised that was dropped in their update, but I thought it was relevant, and I think it's something that we need to think about and look at when we're talking about peer-to-peer lending and risk. Moving on. Easy money. Let me know what you think about that too. Do you think Assets Capital is paying the right amount of interest returns for the type of risk that you're taking in the access accounts? I'm not sure about that. I don't think so at the moment. Easy Money is increasing their interest rates to investors right now. The lowest amount is 4.03%, up to 6.01%. And on December the 15th, they are going to be raising these rates by 0.5% to 4.53%, all the way up to 6.51% for high net worth. So you are going to get a little extra interest rate bump, which makes Easy Money more attractive. Obviously, as interest rates start to increase, we do want to see these return rates increasing, and it's good to see some of these peer-to-peer lending companies taking a real hard look at that, and they understand that if they don't increase these interest rates, people are not going to continue to invest big amounts of money at 4% when inflation is double digits and bank interest is paying, 3 or, maybe you can get like 3% in the bank. You're not going to take 4% all day long for large amounts of money with the risk involved. So you will start to see these increase December 15th. And I think I would just take a gamble and say that I think in January, you'll probably continue to see those rates, maybe February, go up again, because I think the Bank of England is going to raise interest rates too again, and trying to fruitlessly curb inflation. By the way, that doesn't work. If anybody doesn't know, rising interest rates just hurts people like you and me. It doesn't work on inflation. Certainly not in the short term. You have to keep these interest rates high for a long time for that to work. Speaking of that, there's a report, peer-to-peer lending reported or predicted to be among the top assets of 2023. It's funny if you think about 3 years ago, when we were having all these problems with these peer-to-peer lending companies that were going out of business, Funding Secure, Lendy, Collateral, Wellesley & Co., ThinkCats. I'm sure there's more that I've forgotten, but there's a lot of them. And peer-to-peer was the black sheep of investing. And then just 3 years later, we see 2023 is predicted to be among the top assets of next year. People have very short memories, right? I think a lot of these bad companies are being cleared out, which is good. But it sounds very similar to how sort of the cryptocurrency world is at the moment, where we're just having a lot of bad things happen, some bad, unscrupulous people making decisions that are hurting retail investors. Very similar to peer-to-peer, much bigger scale in cryptocurrency. But how things can really turn around quickly in, a sector that was once considered bad, was having a lot of issues, people didn't want to touch. I mean, nobody was putting in money when all of these bankruptcies and administrations were coming through in peer-to-peer lending. People got scared, they started exiting, and now there's a turnaround where the sector is considered a better place to invest. There's been a cleanup with obviously FCA regulations being tightened, and now we're getting these reports about it. Maybe it's going to be a safe haven asset for 2023 because of what else is going on in the financial world. Let's talk about Property Partner. I got this email. Let me log in quickly. I want to show you. They are trying to raise equity. Hang on one sec. See if I put that in right. They're trying to do equity fundraising on some of their properties. They have a very, very tough road ahead of them. They sent out an email. I think Property Partner is, in my opinion, they're just going to have this really tough hill. They haven't released any new investments for a long time. A lot of the share prices, I'll show you here, have really fallen. Even if you're looking at some of the way that their system works, these share prices going up 13%. But you can see here, over here, that there's a graph partially blocked by my head. But if we look at the max, you can see we've had these dips in these Property Partner prices. Say this one, which is considered to have been a riser in their charts, 43p went down to 34p, so we've had over a 20% drop. And then some of the share prices on the property, why can't I, here we go. So this one is the minus 5% one. Again, you can just see how things have really not done well. They've spiked up here and then flat line, so no movement at all, and then a dip. And I think these prices are really down to, number one, consumer sentiment on Property Partner and the properties, the way the business is continuing to operate. I don't know what goes on behind closed scenes over there, behind closed doors. I've been over there, met with the CEO several years ago. Sound like he knew what he was talking about. But I think the way the business operate kind of tells you everything, that if there's no real new investing going on, it's really a tough place to be for a company because it doesn't create consumer confidence. Who wants to put their money into a company where you just don't see any really forward motion, right? It gives you the heebie-jeebies. And they are trying to fundraise, right? Equity fundraise. Let's have a look here. Let me pull this up so I can show you. Oh dear. Hopefully you can see this. They're trying to equity fundraise, and they sent out this email. Let me show you the email. It says there's 5 days to invest in the equity fundraisers, which closes on Tuesday, next Tuesday, 13th of December. Clients have so far invested over $600,000 in the equity fundraisers, representing our largest fundraising in over 3 years. Unfortunately, this level of investment is not sufficient. At this stage, it appears that all 21 properties will not reach their fundraising minimum threshold of 50% and will not complete. That means that if that happens, they're probably going to have to put the properties up for sale, which would crystallize capital losses for investors. So first of all, why are all the properties going to crystallize capital losses? Like, what did you do wrong with your business model that required, when we were in a property, I would say somewhat of a property boom over the last 3 years, all of these properties are crystallizing capital losses. That's not good. So what they want you to do is to put more of your money into these properties. And it says the equity fundraisers are offered at share prices with an average discount to vacant possession value of 35%. So they're giving you a discount to put more of your money in. Let's look at these equity fundraisers on these properties. Here we go. You can see here that these properties are only 10%, 12%, 16%, 13% funded, 9%. So Property Partner has a big problem on their hands because people are not wanting to invest and put more money. One could say throwing good money after bad. This one's only 7.5%. This one's 4.6%. Some are in the 20s, but none of them are anywhere near to 50%. I certainly wouldn't put another penny into any of these loans myself. I think, I've learned when I'm done with investing in certain asset classes. I think Property Partner sounded like a good idea at the time when I was very inexperienced in this type of investing. It made a lot of sense on paper, but if I'd have taken more time to really think this through, and I probably wouldn't have invested. And I think obviously the pandemic did not help them at all. They rely on rents. They've got debt on every single one of these properties. I think up maybe 50% of these properties are mortgaged. It's going to be a very big problem for them that all of these properties are not going to get funded. I would love to reach out to Property Partner and maybe try to get them on the stream. I don't know if they'll come do it, but I'm certainly going to ask. But if you are a Property Partner investor, again, I don't ever offer financial advice. I'm just saying what I believe and what I think. I certainly wouldn't put any more money into this. We've had about 2 years of it receiving very little in the way of rental income yield as was promised. Nothing has really gone to plan, and I kind of put this one down to probable losses when these properties don't get funded and they go up for sale. I don't know if they have a backup plan, but again, this is going to be one for the tax man, I believe. We'll see what happens. I do wish them the best. I don't want to sound too negative, but this is just the reality of the situation. Very sad. Investors are turning to alternatives during recession. A third of UK retail investors are considering alternative assets to bolster their portfolio during the recession. 33%, they've got concerns over the government's handling of the economy. 29% believe that alternative assets are likely to be more resilient in the economic climate. Blah, blah, blah. Well, look, here's the thing. We are already in recession. Let's just face it. And I think now at this point, this becomes about capital preservation, right? You're investing money with the same thinking from 2 years ago, trying to make returns. Now in these markets, I think you're going to get hit. And I've already gotten hit, and I'll show you where. Let's look at the Trading 212 portfolio, which was in the mid £19,000 just a couple of weeks ago. We are now at £17,389. We are looking pretty much in the red in most of the investments that are in this portfolio. This is happening all through the stock market. Disney down 10%, Norwegian down 8%, Vermilion down 15%. Flex is the only one, natural gas, that I've held for a while that's done well. Deutsche Bank holding steady. Would consider that to possibly be a little bit more stable. And then the energy stocks too in the red. And Calera, the golden ticket, this was the one. This was going to be the big one that is now 6% in the red. So it's becoming a case of like, where can you put your money for the upcoming storm to preserve capital? If you have a long time to ride out this storm, I'm in my late 40s, I could probably just leave everything alone for 5-10 years and be okay. Market timing is very difficult, as we know, but these markets are going to present opportunities when this market does really correct, and it hasn't done so yet. I think it's coming. It has to come. Everything is pointing red right now. Danger, danger. Will Robinson. And what you can do is if you have money sitting on the sidelines ready to take advantage of these opportunities, that's how you can make your returns. Now, market timing is extremely hard. Your average person should never do it, probably myself included. But I am sitting with money on the sidelines because I do believe there is going to be a huge opportunity that comes through. I don't know when that's going to happen. It may take another year, but everything is pointing to problematic issues. We have Starling CEO here admitting bounce back loans are not performing. Just news stories like this. Starling Bank Chief Executive Ann Bowden told the Public Accounts Committee that 34.3% of state bounce back loans are not performing and at risk of default. So get your head around that. They funded more than £358 million of loans that are not performing. So 1/3 of all these loans. Now, some of that could be fraudulent. Some of it is just businesses that are not being able to pay these loans back because they're not doing well. Because we know there's a recession happening. Okay, these businesses are absolutely struggling. We see these news stories like this. Unsecured loans are the second most common form of UK borrowing. Right? So a lot of people are using unsecured loans because we're in a recession. They're struggling to get by, and they're having to borrow money on credit cards and unsecured lending forms. Now, very interesting news story came out. I think this was probably one of the scariest things that I've read in a while. Starwood, which is a very, very big real estate investment trust in the U.S., joined Blackstone in limiting investor withdrawals as economic concern spreads. So they've essentially done what Assets Capital has done. She said, hey, we're putting in the limits on how much you could take out of our real estate investment trust. And that means a lot of people are trying to get their money out, right? And these are big funds. Starwood's Real Estate Income Trust is a net asset value of about $26.2 billion. Get your head around that. So people are trying to withdraw their money out because they're scared. They think that these markets are coming down. At least three more REITs have disclosed moves to limit the cash dispersals through the buyback of shares since news broke last week. The Blackstone Real Estate Income Trust took such a step. This is the efforts by the REITs to hold on to cash. They are reducing property purchase volumes. They are trying to stop people from withdrawing because they don't want the prices to collapse. Okay, so just this type of information, this is what we have to look at. This is why, things are scary to me, why I see this storm incoming. And I'm surprised that the markets haven't already adjusted in a much, much bigger way. Looking at the S&P 500, we've had essentially since March of 2020, well, let's see, March of 2021, to correct myself, to now we've had absolutely no movement. FTSE, it's looking pretty miserable too. Okay, so go back here. We're a little bit higher. Actually, FTSE has performed better than the S&P. Was that going to continue? I wouldn't say so. But if we go back here to May of 18, even December, January of 2018, we've had, again, a decline. So we've had, coming up on year number 5 of no returns in the FTSE 100. That's not good. Okay, because nobody knows how to time these markets to get in down here and to get out at the top. I certainly don't. I'm not that smart. So we have a long road ahead of us with increasing interest rates, increasing inflation, and these types of reports saying that these big real estate REITs are stopping people from pulling out their money. That's bad. So another thing in the news that I think is really important to mention, emotional decision making reduces investor returns. The wealth managers that were questioned, 65% said their clients frequently make investment decisions based on their emotions, compared to 11% whose clients don't do this. So that means the one good thing about having a financial advisor is you tend not to mess with your investment portfolio as much. I know certainly when I logged in and saw what was going on in my Trading 212 portfolio, and I've seen that it's gone down £1,600, which, you know, that's 10%. It's a decent amount. My first emotional thought was just to liquidate everything, sit in cash, let the markets just do what they're going to do, which I think is probably end up coming down at some point, and then making a decision later when things are more clear. Because right now, we are not seeing any clarity, you know, in these markets. Just seeing a bunch of movement sideways, up and down. This has been the last 3 months, so blip, and then back up again. The last 6 months, blip. You know, there's no clarity in these financial markets, so it's very, very difficult to navigate. And these emotional decisions that this article was saying is exactly right. You know, if I went into my account and just liquidated everything now because I'm making a decision based on these red numbers that I'm seeing in here, and this all shoots up in a month and ends up costing money. I mean, that's money I can't give away to charity, which hurts everybody. That's bad. So you don't ever want to make your decisions in emotional thinking. But having a financial advisor is one good thing I can say is you're probably not calling them up every day going, oh, buy, sell, buy. You're letting them deal with it. But if you do invest for the very, very long term, and you're putting things like a global index tracker, whatever tracker you prefer, I don't think you have to worry about this kind of thing as much as this emotional decision making. But it is interesting. It's a problem for amateur investors. What else? How long have we been going for? There's one other thing I wanted to show you guys today. Let me listen to this. David Bradley Ward about 3 weeks ago posted a video. He was at, I'm presuming in Abu Dhabi, at a cryptocurrency or some kind of economic conference. So he watched the CEO or founder of Binance come on stage, do a presentation, and then from there, Nouriel Roubini, who is he's a Turkish-born Iranian-American economist. He's a professor at the Stern, or was a professor at the Stern School of Business. Pretty smart guy. Yeah, pretty smart guy. And he made some comments after this guy CZ went on. So I just want to play this to you because I think it's actually super interesting. Hopefully the audio works this time, because it didn't. But let me make sure it's not too loud and doesn't blast you in the ears. Here we go.
Because I wrote he was a crook. And your seat was supposed to be here just today. Kevin Leary was a paid hand for FTX. Good reasons. I hope that CNBC is going to get rid of it. Unfortunately, this is an ecosystem that is totally corrupt. Unfortunately, it is, and I think the lesson of the last few weeks is these people should be out of here. I can't believe that CZ and Binance has a license to operate in the UAE. It's banned in the UK. Is under investigation by the US Justice Department for money laundering, $8 billion of money from Iran. And he's here on this stage, he has residence in this country. The regulators should be thinking carefully. That's a walking time bomb. Okay? So if you invested in us, it's a walking time bomb. Should be kicked out of this country, should not be allowed to operate.
So I think what he's saying is that there's obviously, you know, when things are going badly in a sector, all these people come out of the woodwork and start pointing fingers at other people, saying, oh, this guy's a con man, this guy's a crook. This guy obviously has a hidden agenda because he's pushing an investment product, because he says, well, if you'd invested in us, this is what would have happened. Of course, 2020 is hindsight, right? It's always easy to say, if you'd have done this, you would have made this. And we also know that history is not always prone to repeat itself. It's supposed to, but we're in different times now economically. So just listen to his comments, what he says about if you'd have done this, if you'd invested with us.
I'm sorry to say, it's going to get worse than some big trade, okay? So if you invested in Atlas during the last 12 months, you would have maintained your financial wealth.
So he's saying if you'd invested in Atlas, which I'm presuming is his company or something he's working for, you would have maintained your financial wealth.
Not much of a return, but you would have maintained.
Not much of a return.
If you invested in US equity, you lost 20%.
So if you'd invested in US equities, you'd lost 20%.
If you invested in US Treasury, you lost 25%.
If you invested in US Treasuries, that's bonds, you lost 25%. Don't really understand where he's getting these numbers from, but let's continue.
If you invested in VCs, tech, and growth, you lost 40%.
If you'd invested in venture capital companies, tech, and growth stocks, you'd lost 40%.
If you invested in crypto for the last 12 months, you've lost 75%.
If you invested in crypto in the last 12 months, you lost 75%.
On Ethereum and Bitcoin, they're at the top two. You've lost 80% of your money on the other top 10, and you lost 99% of your money on everything else. So that's where the world is.
So he's basically, you know, coming in as a hindsight person and saying, if you'd have done this, and you'd have been much better off investing with us, you'd have maintained your capital. This is one of the problems with when you try to pick out investments, especially in stocks and shares. His fund or whatever it is he's touting, I don't know, I haven't done any research on it, but trying to pick out the single one that's going to prevail and do well versus anything else is next to impossible. So if we probably look back at historical returns for whatever he's pushing, it probably looks something like that. Some funds would have done really well against his. Some of them would have done badly. Hindsight is always 20/20. It's impossible trying to pick out. But I thought it was really interesting that he went in and, like David says, from AbleRate, CZ of Binance came on, did his thing, and it was all good. Then Nouriel Rubini came on and said what you'll see in this video. Balls of steel to criticize the UAE at the heart of their regulatory system and to call CZ a crook while he's still in the building. Crazy times. I thought that was kind of crazy that this guy went on there and called CZ out. I don't know whether CZ's a crook or, you know, Binance is still seems to be working fine. At this point, it's hard to trust anybody within the cryptocurrency world. Again, it's not the coins that are the problem. It's not the technology. It's not cryptocurrency that's the problem. It's the people getting greedy and running the companies that have fallen down. That's the problem. So he went in there and took his gloves off, started swinging, started pushing whatever his Atlas product is. Takes a lot of courage to do something like that through good and bad. He's probably going to get a lot of backlash. I thought it was interesting. David was sat, I'm presuming, I think he was there. I'm presuming he was there. I don't know if he was or not, but I think maybe he was sat in the audience watching that. So I thought it was very interesting. I just wanted to kind of play that for you, see what you guys thought. Anyway, hit the thumbs up if you're enjoying the stream. We'll take a look at your comments, and we've been going for 54 minutes, so got to take the dog out soon. Thank you for joining again. Glad you had a good time. Patty missed the last few sessions because he had some problems with his rental properties. That's not fun. Late pairs with rentals. Ah, you see, another look into the economy, right? So we look for these telltale signs. Patty's renters are paying late. Hola, Annabelle and Iron, nice to see you. Dave Dawson is here. Alan said, how did Assets get those awards? Big ups to Kuflink. Screen froze, no. Good. Propland, thumbs up. Problem with Assets Capital is the defaults, I agree. I won't hold you to it, Lawrence. What's your view on the maximum investment in any one peer-to-peer platform? I have 47,000 out on 5. I feel uneasy. That's a tough question because it depends on what your overall picture's like. If you have a net liquid investment amount of £1 million, then you've got 4.7% in peer-to-peer spread out over 5 companies, you're totally fine. If your net liquid net worth investing amount that you have is 100 grand, then you got 47%, then yes, I would feel uneasy too. I tend to not want to put more than, at this point, 10% of my available liquid net worth into like an alternative investment like peer-to-peer lending or cryptocurrency or anything like that. And I would probably just spread that 10% out over 5 quality companies. Paul News never lost any money with easy money. Annabelle, not impressed with Assets Capital, the way they're treating their lenders. Honestly, they're treating them the way that their terms and conditions say, that nothing is guaranteed. And you're not guaranteed to get your money out. So they're doing what they need to do for market conditions that they consider abnormal. If secured loans are second biggest form of lending, surely that means, if unsecured loans are second biggest, that means that secured loans are the biggest. All loans are either secured or unsecured. Absolutely, that would make sense. Okay, yeah, I think Patty, if you have a total amount, just figure it out at percentages. I think you're probably totally fine. You're less than 10%. I think cash flow is going to be very important when this recession really kicks in, because right now we're in it, but we're not really in it. We're not knee deep in it, but cash flow is going to be everything. But everything has its risk, right? Even if you own buy-to-lets, people don't pay. Now you're on the hook for everything, so there's risk involved in that. Nothing is clear-cut. With investing at the moment, thinking about what's coming in the future, nothing is clear-cut. There is absolute risk everywhere. This could be one of those times where doing nothing is exactly the right thing to do, even though inflation is high. But it could be a case for gold. Gold is kind of held up through these difficult times. Dropped a little bit here and there, but I think it's about $1,700 US an ounce at the moment. So there could be a case for some gold. Who knows? It's very difficult to navigate. Yeah, I think I probably would feel good being a majority in cash for the next 6 months. I'll take a 6% hit on the inflation cost rising. Having a 6% inflation hit is a lot better than losing 20 or 25% on an equity share that went down. I'll give you an example. Let me show you something here. On the trading 212. Hold on. Let me pull it up. I had a little plan of action that didn't really work out very well. Zim integrated shipping. You see when I bought. Let me look at the history. So I bought on the 25th of November 23 shares of Zim at a cost of £500, a price of how much did I? Let's give me some weird numbers here. How much was the market price? $25.65, right? This was November 25th. Look at the price today, $18.51. Now they did pay out a really big dividend today, as you can see here. This is kind of what makes dividend investing somewhat dangerous. Now, Zim is a lot more risky because the dividends are so much higher. As you can see here, they paid out a dividend of £132, right? So on 73 shares, £132. So a massive, massive dividend, but it doesn't really help you if you consider that this stock has fallen from when I bought it at 25, which was here, of course, and now it's gone down to 18. So you see, this is the problem with dividend stocks. They don't always hold up NAV value. So yes, you're getting a great dividend, but now I've taken a, what is that, $25, so a $7 loss, 10%, 15% loss. But then you add the dividend in there, it's not so bad. It pads out some of this loss, but you're still in the red. So again, there is no, I don't think there's any safe place other than, you know, maybe savings accounts right now that is going to get eroded away from inflation. There's certainly nothing that's 100% safe. And even bank accounts, I mean, you put your money into savings and something happens with those banks, there's always that risk that the government cannot bail out all of the banks if something, you know, really were to melt down. Look at what happened in Iceland. We've seen it in different countries. People make a run on the banks. There's no money in the banks because they don't have to hold any reserve to pay you out. So if everybody runs on the banks at once, what are you going to do? Your savings are going to be stuck. That's why maybe gold, you know, actually physical gold might not be might not be a bad thing to diversify into, having some physical gold, because banks, you know, they can get frozen. Is it likely? Probably not, but there's certainly a possibility it can happen. And stocks and shares, honestly, as my friend likes to say, they're fugazi, they're paper. It's just in the air. Poof. Seen that movie Wolf of Wall Street? Perfect example. How this stock stuff is just not controlled by anything that we can possibly understand. Just certainly being manipulated. So you got to be careful. Everything has its risk. As long as you understand that, diversify out. Hopefully we'll all be okay. I'm certainly concerned, though, not to be all doom and gloom, but this is just the reality of where it is. And I know, yes, I understand there are some dividend stocks that legal in general, and you know, they are going to move, though. They are going to move in price. So you're going to see some, if the stock market does do what I think it's going to do, everything is going to get hit. Except maybe gold. Who knows? We'll see. Richard says the fourth way research never rated easy money as they wouldn't answer all the fourth way questions. Yeah, I get that. Mortgage free. Yes, I think that's super important. Patty says be debt free. Debt free honestly is huge. Being debt free is huge. If you're not debt free, you're at risk too. Not all of us can be debt free, but if you can be debt free, it's not such a bad place to be. Yeah, legal in general. I get what you're saying, David. Totally understand. You know, you just have to understand that you're probably not going to get that price appreciation, and legal in general stock will get hit just like everybody else when the markets do poo on us all, which is coming. Anyway, listen, love you guys. I really do. Thank you for being here. If you feel like supporting the channel, you can join, become a YouTube member, and it's very cheap. It's less than $5 a month to support the channel. You become a Patreon member down here. Allows me to buy that little dog in the background, dog food. And but yeah, I love you guys. I appreciate you being here. I'll be back next Thursday, God willing. Have a great weekend. Be safe out there. Enjoy your families. Enjoy your friends. There's more to life than money, right? Remember that. As much as we talk about money, there's more to life than money, for sure. So I will see you next week. Take care. Bye-bye.